Check out my podcast on Apple and all other streaming platforms, Deep Economic Thoughts with Ivan Illán. Also, visit our website to learn more about our ACGM Total Portfolio Solution Suite. This is Ivan Illán, the founder and chief investment officer for Align Wealth Advisors Investment Management, also known as AWAIM. What you'll see behind me is a recent research highlight, and this is published on our website earlier in the month of March. And what it talks about is the rapid rise in credit card delinquency rates that we've been seeing. And it's been quite dramatic. There's about a 50% increase in the 90-day delinquency rate for credit cards in 2023. That's what the New York Fed has reported. And we see that the overall percentage of delinquency is actually right now is hovering around 9.74%. And the long-term average has been around 9%, so that in and of itself isn't that alarming, the fact that we're just a little bit over the long-term delinquency rate. What is alarming is that the long-term delinquency rate, most of those interest rates were around 13%. And so today we see around a 21.47% average credit card rate. And so when you see such an incredible amount of interest that is being charged on credit cards, and to see this rapid decline, rapid decline in the savings that folks had, close to about 4.4 trillion at the peak of the second quarter of 2020, all the way now down to around 800 billion. So this is around an 83% decline, which is quite significant. So households have less cash savings. Their credit card balances have ballooned northward of $1 trillion. It's being charged, that debt is being charged record amounts of interest. And certainly we see this now reflected in very rapidly increasing delinquency rates. So certainly this is a backdrop that gives us some pause for concern, and certainly something that we will continue to watch as things unfold. And what will the Federal Reserve do? Are we going to see rate cuts anytime this year? It's our belief that rate cuts would be a bit premature at this point. It's still too fragile in the economy, where we see so many prices still highly elevated, and disinflation, or slowing of the rate of growth of inflation, is still not significantly reduced. We're still in that over 3% range, which is above the Fed's target. So even though we are seeing unemployment actually increase, this is a positive sign actually in the economy that things are starting to slow down, which should further impact disinflation and seeing the rate of inflation continue to decline. But our belief is that we should actually hope for some kind of deflationary environment. And unfortunately, deflationary environments are usually in part of the makeup of a recessionary environment. And so this is something to be aware of. Certainly the impact on fixed income instruments, whether they're investment grade or high yield. And within the high yield market, we continue to see very little credit risk at play. Yesterday, when we were looking at the spreads on triple B, which is the lowest rung of investment grade corporate bond rating, that spread is incredibly low, very tight, at around 117 basis points, meaning you get essentially an additional 117 basis points of yield or income relative to a similarly maturing risk-free bond or a U.S. Treasury bond. So for an extra 100 basis points, is it worth it to take on corporate risk, especially when you're in that triple B category? That's a category that you can readily see downgrades from triple B into double B plus, which would put it into a high grade, the highest rung of the junk bond status. That's a pretty significant event, however. That is a credit event. And so we are concerned that you don't see widespread credit risk as an element of the fixed income market at this point, and we think that's a bit silly. You should kind of see a little bit more concern in the fixed income market, and we certainly don't see that, and we're certainly not seeing much concern in the stock market as well, as it continues to do extremely well. So. And from our standpoint, we're allocated very light towards the mega large cap U.S. growth stocks. We are preferring other areas of the U.S. stock market that have better values, better prices in the market compared to the valuations that these mega large cap companies are selling at, which comprise a significant component and proportion of the S&P 500. So for our clients, we're certainly being more defensive in nature when it comes to the equity exposure, and we continue to be very defensive and opportunistic in the fixed income side of the equation. And that's partly being driven by statistics like this and data like this that isn't particularly confidence inducing, and we'll continue to be on the watch. Thank you.